I'm Jermal Chandler. I used to be an engineer, and now I'm a trader. So I have a degree in material science and engineering, and I worked at a prop firm at Peak 6 Capital Management for 8 years, traded options and trading volatility. I also have a little experience on a couple other sides of the business. I worked as a regulator. I also worked at FINRA, but I also worked as a regulator at Cboe Global Markets. And then eventually I started this educational side of the business at Cboe Global Markets in their Options Institute. I joined Tastylive in 2021. I'm on Engineering the Trade, which is my show where I talk about the markets, macro things and volatility, and This Week in Stocks. Why trade options? This is a question that we get asked so many times. What's the interesting part about trading options? What makes them unique? Well, there's many, many things. We're going to discuss and cover a bunch of them. Capital efficiency is probably one of the bigger things about trading options. You see, when you trade options, you need leverage to give you the necessary occurrences that give you a chance to win in these markets. Leverage is important because for every one option, it's 100 shares of stock. Stocks have really gotten expensive. I mean, have you looked at the prices on some stocks these days? NVIDIA is over $400. Microsoft is over $330. Stocks have gotten really expensive over time. And so as a result of being able to use options and use the leverage they provide, you're able to stand a chance and be able to trade in the market. You got to choose your level of leverage when it comes to trading options. So you have defined options, defined strategies, you have undefined strategies, and learning how to use them will allow you to be capital efficient in the markets. Also, with capital efficiency, normalizing price differentials are allowed to be done when you're trading with options. It allows you to trade a $40 stock and a $400 stock in a very similar way. So these are the ways that capital efficiency can allow you to stand a chance in markets. Why else do we trade options? Well, the strategy and product diversification is another important reason. You see, the strategies, they actually allow you to trade any given market. Sideways, up, down, doesn't really matter. That's what strategies can do when you're talking about trading options. Strategies also allow you to optimize mechanics. Now, this is something that when people are first learning to trade, they try to figure out, how can I find a way to use this strategy to trade this way or trade this name? This is actually what strategies allow you to do, and we'll talk more about this later. Strategy and product indifference, now those can be used to reduce P&L volatility in your portfolio. Something that a lot of newcomers struggle with is the amount of swings that they'll see in their portfolio when it comes to trading, and they're trying to figure out how can they minimize it. Now, if you use strategies, that's one way to really help you get better at it, but also being product indifferent, being willing to trade gold when the implied volatility is high, or being willing to trade grains when implied volatility is high. However you want to look at it, trading a lot of different things that don't necessarily have a lot of correlation helps reduce your P&L volatility. And that's one of the things that options allow you to do. Additionally, when you manage early with options, you're able to eliminate most tail risk. A lot of times, what we often talk about doing is trading at 45 days and then closing or rolling at 21 days. And by doing this, you're allowed to manage your tail risk and keep yourself still in the game. Why else do we trade options? Well, probabilities is definitely one of the bigger reasons why we're looking at trading options. So the house always wins when people are talking about casinos and other unregulated markets. The difference is with liquid financial markets, that's not the case. We often see that you have a much more of a chance, and on a day-to-day basis, nobody knows anything when it comes to trading. And this is one of the things that using that leverage with options will help you do. The other thing about stocks is, well, they're 50-50. I mean, when you buy a stock, you really have a chance of it either going up or down. And that's really pretty much your main probability that's on your side, which is not a whole lot. Options are actually user defined. You can define your risk when it comes to options, and you define your probabilities. That's one of the big things. So for that reason, we try not to rely on luck. That's not the way we're trying to do it. We're trying to rely on the mechanics, on the edge that we have, and the strategies that's going to get us to where we want to be with options. So probabilities, at the end of the day, end up being the great equalizer, regardless of stock size, stock price. Because of options, you're able to use probabilities in your favor and define them in any way you want to be able to give yourself a chance to win. Why else do we trade options? Again, we said you were able to have defined risk trades and undefined risk trades. Now, whether you go undefined or defined really depends on your capital availability. If you don't have a whole lot of capital, most times you're going to have very defined risk trades. But if you do have the capital to do both, don't be afraid of undefined risk trades because those end up having a higher probability of success. And so again, having that expected probability of success, what you're looking for is different ways to define it for yourself and put yourself in a position to win. The other thing about the different strategies, whether defined or undefined, what really also determines it is the market. So depending on how implied volatility is, whether it's high or low, that will be determined by defined or undefined risk trades. The price of the stock, or even the liquidity within the stock that you're trading. For example, if it's a very illiquid stock, then more than likely you're not going to be able to get two legs of a trade, which usually is a defined risk trade, more than likely. So that's something to keep in mind. So there's also advantages for rolling and adjusting your trades when they're defined and undefined risk trades. And that's something we'll discuss later on in this presentation. Why else trade options? Industry innovation is one of the big reasons why. Front-end technology has changed so much throughout the last 30 years. You're able to do things now that you couldn't even do once upon a time. You're able to see a lot more things and have the ability to look at a lot of different types of tools. tastytrade's platform is one of the most interesting ways that you can do that. That's one of the reasons why you'll see it being the ability, gives you the ability to have a fighting chance in the market. Trading costs have gone way down over the years. Once upon a time, you had to call a broker and place a trade, and it was very expensive to do. Now, nowhere near that amount. It's next to nothing to be able to get a trade on and express your opinion. HFT liquidity, that's one of the things that has gotten a real bad rap. High frequency is often discussed in sort of negative connotation. But the truth is that high frequency trading has taken a lot of the other side of a lot of trades, and it gives you the flexibility to put on trades in ways that one would never imagined once upon a time. So this is another important reason. And then finally, product innovation. Just about every day, there's new products being created, new ETFs, et cetera, that allow people to express their opinion in a lot of different trades in a lot of different ways. These, in sum total, are the reasons why we trade options. Now let's explore the math and finance of why we trade options. Quite often, when you're talking about options trading, sooner or later you will hear about a probability distribution. Let's simplify a probability distribution. Let's just say you have 100 people in a room and you start putting everybody in buckets by height. 5 foot to 5'5", 5'5" to 6 foot, 6 foot to 6'5", and then 6'5" and above. So as you're starting to place people in these buckets, you will eventually get to what's considered a probability distribution curve, such that the next person that walks in the room, there's a good chance you'll be able to determine what bucket they might fall in. And this is one of the things that we do often when we're looking at options montages, when we're looking at option strikes. This allows you to get an idea of your potential probability of profit by looking at it from the standpoint of a distribution curve. Where's the meat of it? Where's the outer liars? Option pricing skew is very important when it comes to option mathematics. Now, this is a concept that I think a lot of new beginners typically don't understand, but it's very simple, to be honest with you. If you think it from the standpoint that most people are stock buyers, they're looking to purchase stock in the market. And as a result, at some point when the fear kicks in, they're looking at ways to hedge it. And most of the time, you're going to look to get short delta. There's two ways to get short delta, two simple ways to get short delta: getting long puts and selling upside calls. So these are the ways that people are usually hedging their long stock. And as a result, this creates inherent skew in the market. And often in this situation, we're talking about equities, you'll often hear about skew being to the downside. That's because most people are buying downside and selling upside, short delta trades, just to hedge off their long stock. And as a result, those option prices end up being perceived in the market as higher for the downside and then sort of cheaper for the upside. But that's on a volatility basis. If we look at the chart, you'll see that the 16 delta distances from at the money for puts and calls often differ. So if we look at 15 days to expiration, you'll often see a 3.9% difference on average of a put from at the money versus a 2.4% difference from the call from at the money. When you go out to 30 days, this exacerbates a little bit more. 6.5% to the downside for a put that is 16 delta versus a call of 3.9% to the upside. Then yet and still, we see at 45 days to expiration, just a bit more difference when you're talking about 8% to the downside and then 4.9% to the upside for the same delta call. So essentially, this means that puts are more expensive than calls, and the strikes are further from at the money than those calls. Correlation basics. Now, this is something we touched upon earlier, and this is something to expand upon now. Most of the times when you're looking in markets and you're trying to trade, you're just looking at the implied volatility and you're not really thinking about much else. But I venture that you should at least examine the differences in the correlation of the products that you're trading. If you're trading SPY and you're trading Qs, more than likely those are highly correlated because they typically will move together regardless of the reason of what's going on in the market. High correlation, high positive correlation are things that are typically moving much well together. However, on the reverse, we'll often hear about high negative correlation, things that don't necessarily move together. Good example of this is SPY and GLD or gold. Most often, gold does not care what SPY is doing, and they're moving in opposite directions most of the time. So having highly correlated names in your portfolio, it can work out for you if everything's moving in the direction and it's moving in the direction of your delta and trade, but it can also work against you if you have too much of it. And so this is one of the reasons why you have to pay attention to correlation, because it can disrupt your P&L volatility often. So having highly correlated names, maybe a few here and there, but also having a couple of highly uncorrelated names is also essentially good for your portfolio. Measures of outlier risk is something I think people are most often concerned about, particularly when you're having undefined risk trades. So we all know that short options can carry significant risk and potential outlier risk when we're trading. One of the ways we can look at this is value at risk. An even better way is conditional value at risk, which is on the Tastytrade platform. Now, value at risk sort of gives you this estimate for worst case scenario in a move. So you have a downside put that you're short, which is, if you get assigned on it, eventually you could be long stock. And maybe most people are comfortable with that given the strike that they chose, but some might not. Some might just want to be short the put and hope that expires out of the money. But oh no, all of a sudden you could have an adverse move and you're worried about your risk. Well, conditional value at risk is a more smoothed out way to get an example of how much you might lose given an adverse move against your short options. So this is something you can look at going forward, and you'll see it on the Tastytrade platform. Next, let's discuss the nature of volatility trading. Trading volatility is something that I think a lot of beginners to options don't really get a grasp on. Many times, you'll hear about people who are trading from the long side, and they buy a call. They get the stock move to the upside that they think is sufficient for them to make money, and all of a sudden, they're trying to figure out, why am I losing? This is because volatility has likely changed on you. So implied volatility is often derived from the option price, and it gives you an idea of what investors are willing to pay for an option at any given point in time. When option prices increase, it means there's just a little bit more fear in the market. And when they decrease, well, then of course there's a little bit less fear going on in the market. So essentially you could say that implied volatility is a perceived risk in equity markets at any given time. And it gives you an idea of how fearful investors are when it comes to trading. So one of the best things to keep in mind is that implied volatility is usually correlated to price. When you see an equity name that moves down really big in a very short period of time, typically it will also accompany implied volatility going higher, and sometimes vice versa. But it's also important to understand that if it does have a violent move to the upside, you can see implied volatility increase there too. So implied volatility in some ways can be said to seen increasing when we have large moves in either direction, something to keep in mind. Expected move is one thing that traders are always interested in, especially option traders. Option traders typically want to know, what type of move can I expect from this given asset, given the conditions that's going on in the market? Now, because implied volatility is often from how investors are anticipating future markets and future moves, expected price is one of those things we're always paying attention to. Expected move is one of those things that option traders are always paying attention to. And if you take the straddle price and divide it by where it's currently trading, you get an idea of what type of move in either direction this either stock or commodity might move. Now, specifically, implied volatility is usually estimating the standard deviation of that expected price move. It's one of the things that you always want to know. If you're trading to the downside, you want to get an idea of what move might happen, particularly if it goes through your strike, something you need to pay attention to, something you want to know. Most importantly, implied volatility is often overstated about 80% of the time for the S&P 500. So this is one of the reasons why you hear about a lot of traders wanting to sell options because of this overstated nature. One of the best things about trading volatility is that, to some degree, it typically has a standard operating procedure. You see, most of the time we'll hear about volatility being in a lull state. Eventually, we'll hear about an expansion state and see the volatility moves higher. Now, just like stocks, it's hard to top tick. You don't know when it's going to stop, but you do know at some point in time that implied volatility can't remain elevated for very long, and eventually we will see about contraction. Now, you think about different regimes in the market. 2008, we saw volatility in a lull state at the beginning of the year. We saw it begin to creep higher in the summer, and of course, many different factors created volatility expansion in 2008. Of course, what was going on with the entire banking system was really one of the things that pushed implied volatility higher. And it stayed somewhat elevated for months, eventually pulling back into contracting. But it didn't contract really until the following year, just about in 2009. 2020 is another example during the COVID time period. Now, we saw a very, very fast expansion and contraction in implied volatility. This is one of the things that really was unheard of and never seen, to see such a fast movement within a few months time period. So what we typically see is this unsustainable ability for implied volatility to remain high forever. This is one of the reasons we often try to take advantage of this by selling volatility, because eventually we want to participate in the contraction phase. Now, that means you have to sell through the expansion, and you don't know when the expansion is going to end. But this is one of the reasons why you're often trying to trade small, right? For SPY, it's often been in the lull state about 70% of the time. We'll see the expansion state about 10% of the time, and then we'll see the contraction state about 20% of the time, just to give you some numbers behind it. Now, we're able to construct a trade. Choosing an asset and an underlying is the first thing you're going to go about doing. But it's important to remember that liquidity is king. Liquidity trumps everything else that you're trying to do. You have to be able to get in, you have to be able to get out of the trade. So typically what you want is an underlying with a very liquid options market, one that has high open interest, one that has a lot of volume across a lot of strikes, one that has tight bid-ask spreads. Again, being able to get in and get out is essential. And then you want to be able to find a trade that has contracts with a lot of different strikes and expiration dates. Now, the higher the volatility, that's going to sometimes result in wider bid-ask spreads because, well, a lot of times market makers are unwilling in a higher volatility environment to make decent markets, and that's why you'll end up seeing that. So often try to focus on very liquid markets, those that have a lot of volume, those that have a lot of open interest across strikes. It's important. Next, you want to choose a duration. This is something that I think a lot of people struggle with when they're looking for a trade. Sometimes they don't have an idea on a timeline where they want for an action or whatever trade that they might be doing. They might look out at leaps, they might look out 3 months, 6 months, and it can be a daunting task trying to figure out exactly where you want to land on this. But I think it's important to at least comprehend what options often do, and that's decay. Options are often decaying vehicles. So as a result, if you are selling options, what you want to pay attention to is the decay curve and how much your theta is over time. We've done a lot of research that shows that the decay curve is most optimal in the 45 to 21 day window, where we'll often see the largest amount of decay. But when you're choosing that duration, you first have to choose something that uses your buying power effectively, something that's going to allow you to consistently get a lot of occurrences, and something that's suitable for the current market or what's going on at the time. Is the market slow? Is there a lot of volatility? What's happening? So understanding all of that and putting that into context is important. But to keep things simple, we're often paying attention to a 45-day window with regard to decaying. And we're typically either closing or rolling at 21 days. We have found a lot of our research has told us this is the most optimal when it comes to trading options. You do want to keep your position in a less volatile area, something that's within that sweet spot. And that's one of the reasons why we often do that. Next, after you choose duration, of course, you have to choose strategy. Now, this is where things start to get a little bit complicated. The most important thing when choosing your strategy is size. You see, size, oftentimes they say size kills, and for good reason. If you put on a trade and it's too big, then most of the time you're paying attention to it so much that it's probably dominating your portfolio and dominating your risk management abilities, and you're not really paying attention to many other things. The other thing about having too big of a size, if you're nervous about this trade day in and day out, you automatically know that it's probably too big for you. So size is important. Try to stay as small as possible compared to your portfolio. In addition to position size, you want to be capital efficient. You want to be mindful of risk, particularly when you're talking about those undefined risk trades, but don't run away from it because, again, those typically have the highest pop for you. And you want to choose the appropriate strategies given the implied volatility in the market. In high implied vol markets, those are the times where you're probably looking for those undefined risk trades because they are high in pop. You're probably looking to sell in high implied volatility markets. When it's low implied volatility markets, a lot of times you might be looking to buy, might be looking to do the defined risk trades, straddling the stock price. Those are the times where you're paying attention to that. Those are the times when you're paying attention to those strategies. And that's how you basically choose in between strategies, given what's going on in the environment or in the market. It typically will let you know. You do often think about choosing a directional assumption. Many times, folks want to look at a way to trade something because they have a belief that it's going to move in any given direction. It's understandable, but you should understand that it's okay to be aware that nobody knows anything. Now, for that being the case, if you assume the current prices reflect some degree of available information in the market, well, that's essentially a semi-strong efficient market hypothesis. That essentially means that you are aware that nothing is happening, you have no control over it, but that being the case, you could still have your own directional assumption. One of the things we often try to do is have an assumption on volatility, because as we said, it's a little more predictable. About 70% of the time it's going to be in the lull state, about 10% of the time it's going to be the expansion state, about 20% of the time it's going to be the contraction state. So if there's any one area we're often trying to sort of take a directional assumption in, it's directional in volatility. We know that volatility is eventually going to rise, and eventually it's going to fall somewhat slowly. Finally, you want to choose a delta. You choose your strategy based off of what your capital availability is, but you choose your delta for different reasons in giving yourself a chance to win. Delta, of course, is the perceived risk in terms of options, in terms of shares. What direction is it going to go? What's your current delta, and how is that going to benefit you or hurt you? Something you need to be aware of. What we've done here is 16 years of research looking at different strangles based off of the deltas that they have. It's interesting to note all the different statistics and how they change amongst them. 16 delta, strangle, pop is 81%. The average P&L on that is $44. Your P&L standard deviation, somewhere around $614. And your CVAR, of course, when we're talking about that smooth way of looking at your value at risk and what an outsized move could do to your position, that's $1,535. Now, if you go from having a 16 delta strangle and you move into the 20 delta, where both options are 20 delta, you'll see a little bit of change. Your pop all of a sudden is 76%, right? So we went down from being at the 16 delta strangle. Your average P&L, of course, goes up because you're selling a little bit more meatier options there. And your P&L standard deviation, well, that's about $659. But the CVAR, of course, goes up because now you're a little bit closer to where the stock is trading, a little bit closer to at the money. And so an adverse move, of course, well, you have a meatier option, and so then it can get you a little bit more trouble. That CVAR ends up being $1,673. 30 delta strangle. So once again, we moved in just a little bit more. You'll see a pop of about 68%. Average P&L about $54. P&L standard deviation, of course, that increases to about $747. And naturally, because we have a little bit more meatier options, CVAR now is up to $1,931. So having short deltas, your premium on that is going to generally range about 10 to 40 delta oftentimes, right? So it's important to understand how your risk changes as those fluctuate from time to time. I'm Jermal Chandler, and I have a show called Engineering the Trade that comes on Monday through Friday, 1:45 p.m. Central Time to 2:15 p.m. Central Time on Tastylive.com and also on the Tastylive YouTube. Talk about macro trends, talk about trade ideas based on volatility, and how your Greeks can help you manage your portfolio. Check that out.
Hello, everybody. Welcome. I'm Tom Sosnoff, and hope you enjoy today's four-part, let's call this our first digital collectible or digital show. We're very excited. Myself, Pete Mulmat, Jermal Chandler. We have tons of content for you. It's almost 3 full hours of content, and it's yours to own forever. And these are kind of it's a little bit of a derivative of what we did in all our live shows this year around the country and around the world. And so I hope you enjoy it. It's tons of content that talks about options, futures, options on futures, and mostly all strategy. And think about it as every 5 or 6 minutes, there's a pretty important takeaway, and we'll highlight the takeaways. I hope you enjoy it. I like to say, welcome back, my friends, to the show that never ends. And I hope you get a lot out of this. I hope you research it, you watch as many times as you'd like. And just remember, on the option part of this, there is a tie back to Julius Spina's book, The Unlucky Investor's Guide to Option Trading. Julia's book was a bestseller in the world of finance. It's been out for just a little under 2 years now, and it still remains at the top of the bestseller list. She's a physicist. She's on a research team. It's a book that focuses on the quantitative side of option mechanics and option strategies, and you can find the links back to the pages on the option part of this. And the cool thing about today's discussion is, even though we're talking about options and Jermal Chandler and myself are focusing on the option portion, and Pete Mulmat and myself are focusing on the futures portion, but everything's interchangeable. The mechanics for the option side are interchangeable with the future side. And I think you'll, if you are able to absorb as much of the content as possible, you'll see how it all flows together in the end. So the piece I'm going to do on the option side to complement what Jermal's done is I'm going to talk, and I'm going to start off with the concept of managing trades, because one of the neat things about derivatives trading, one of the neat things about being a self-directed investor is that you get to do what you want to do. The counterparty's role in the whole marketplace and marketplace efficiency is facilitating what you want to do. Their edge is they have a tiny little edge in price, facilitating what you want to do. Your edge as the self-directed trader, your edge is that you get to do whatever it is that you want to do. So you get to control your opportunities. You get to control order entry. You get to control all your own decision making. Nobody forces anything on you. That's your advantage. The counterparty's advantage is they get a small advantage on price. You get the advantage of getting to do whatever it is you want to do. And in an efficient marketplace, I like I like your side, which is the same as my side, a little bit better. So one of the things is initiating a trade. That's fine. We're going to talk a lot about that today. But the other thing is when you have initiated the trade, you get to control all your next moves, because in an efficient marketplace, one of the coolest things about it, and this is the world of options, is that you get to decide what you want to do after you've actually made the trade, you've executed, you have it on. You know, in the world of flat out futures, there's very little strategy. There's a little bit of what we call pairs trading. We'll get into it later, but there's a little bit of, directional trading, obviously, and there's highly correlated positions where you can bet on the basis and you can bet on different things happening directionally. But essentially, in the world of futures trading, the market's very black and white. In the world of stock trading, the market's even more black and white. You can buy it and hope they go up, or you can sell something and hope it goes down. But that is pure black and white. And in the world of digital assets, that would like Bitcoin and things like that, that's a very black and white business too. You buy it, hope it goes up, you sell it, you hope it goes down. There's nothing else to it. But the world of option trading is very different. It's very strategic. We like to call it it's an area of gray. It's gray colored, which means you can actually be right and lose money, or you can be wrong and make money. And it's strategic in the sense that it's very mathematical. It's very probabilistic. All the outcomes are theoretically spot on when they happen. When the trades are initially executed, all the theoreticals are spot on. And then over time, how you manage those trades, or how you adjust those trades, or how you close those trades, whatever it may be, is really going to make or break how well you do as a do-it-yourself investor, as a self-directed investor, as somebody who's managing their own money. In a world of higher interest rates like we have now, in a world of very high risk-free returns, one of the great things about being a do-it-yourself investor, a self-directed investor, is that you have an opportunity to set your objectives, and they can be at a significant multiple of whatever risk-free rates are. Whether you achieve that or not, that's up to you. I mean, that's up to your skill set. That's up to how much risk you take. That's up to how many occurrences you have. But at least the opportunity is there to achieve some return over a passive return, some return over a risk-free return. So I'm going to start out with a segment that I call managing trades. And the reason managing trades is so important is because one of the things that I've learned in the last, we started Tasty almost 13 years ago. It's hard to believe, but it's been almost 13 years. And just to give you a little tiny bit of background on me, because some of you, obviously know us, and others have no idea who we are. I started this business actually a little over 40 years ago, and I started as a floor trader, market maker on the floor of the CBOE. I went from the floor of the CBOE. I was down there making markets in the S&P 100 for almost 19 years. And in 1999, 2000, I left and went to build Thinkorswim, which we were the founders, and I was the CEO. And we built a company called Thinkorswim. We were a publicly traded company. In 10 years after that, in 2009, we were bought out by TD Ameritrade. In 2011, or 2010 actually, late 2010, I left to start Tasty. We built Tasty Trade in 2000 and started in end of 2010. 2011, we launched Tasty. Tasty Trade is now the brokerage. Tastylive is the network. And so we've been going pretty close to 13 years nonstop, every single day creating content. Tastylive today is the largest digital network for finance in the world. We're also the largest think tank for options. We create more content than anybody, and it's all free. It's amazing. And it's really interesting stuff. We've learned a lot. Well, one of the most important takeaways that I've had in the first 13 years is about risk mitigation, with specifically outlier risk mitigation. So we all know that consistency and discipline and all that kind of stuff is critical, but how do you mitigate your outlier risk? Because the thing that most people worry about when it comes to being a self-directed investor, and one of the reasons that a lot of people will dump their portfolio on somebody else, or have somebody else, or pay somebody else to manage their money, is because they're worried about outlier risk. But the reality of outlier risk is nobody can control outlier risk. There's only two things you can do. One thing is you can keep your trade size relatively small. I know that seems like common sense, but you'd be surprised how difficult it is to keep trade size small. But if you keep your trade size small, you essentially eliminate most of your outlier risk. One of the sayings we like to use is when genius fails, the only time genius really fails is when your trade size gets too big, because everybody kind of has an idea of what they're doing. Everybody kind of understands how the game's played. So when does genius fail? Well, when you trade too big. So keep your trade size small. But the other thing is, and this is the kind of thing that most astounding to us and something that we figured out through a little bit through trial and error and a lot through research, was that there are huge benefits to managing your positions before expiration. So let's say, for example, our research shows that 45 days, 45 DTE, which is 45 days to expiration, is the optimal time for putting on a trade. Well, let's say, years ago, we used to think, all right, we're going to let that thing go as far close as we can to expiration, because premium decay will accelerate as we get closer to expiration, and your theta will pick up, and you'll make a lot more money if you hold it all the way to expiration. What we never realized was that based on dollars at risk, you're actually taking more risk holding something all the way to expiration, because you're not eliminating your outlier risk. And so in the end, after doing thousands of hours of research and studies with respect to where in the decay curve is it best to manage a position, we finally figured out, oh my God, it's much better to manage positions before expiration. The benefits include you can create a lot more occurrences if you redeploy the capital. And the most important thing about more occurrences is, in a world of law of large numbers, more occurrences, better performance, and closer to your expectations. You have significantly less outlier risk when you manage a trade early, because early in the decay curve essentially eliminates outlier risk in the second half of the decay curve, which is when almost all outlier risk takes place. And then you have, and this was very surprising to us, you have a higher average daily P&L when you manage early. So again, the three most important takeaways about managing a trade early. Now, managing a trade early would be like a 45-day trade, you manage it 21 days. A 30-day trade, you manage it 15 days. A 10-day trade, you manage it 5 days. A 1-day trade, you manage it 3 hours. That's what managing early is. But again, it creates more occurrences, it reduces your outlier risk, and it gives you a higher average daily P&L. So with respect to that, what about a management strategy? Like what are some of the examples of that? As you can see here, we're posting all the slides that we've used, and in the upper right-hand corner of all these slides, you will see a page number. And those page numbers will take you back to a page in Julia Spina's book, The Unlucky Investor's Guide to Option Trading, which will give you all the detail and all the backup math for everything that we're discussing today. That's why this is such a cool event. So when choosing a strategy, consistency is essential. And again, I know that seems like it's like, okay, that seems obvious, but sometimes we have to be a little bit masters of the obvious. Managing contracts according to days to expiration, it simplifies everything. It actually gives us some context around the concept of managing early. So what you can see here is that contracts managed early are less likely to profit and collect less per trade, but also have less volatile P&Ls, less tail risk, and collect more theta daily. So as we posted on this trade here, on this slide here, you can see that where we highlight 21, well, we actually didn't highlight this slide, but at 21 DT would be kind of the center of this page. And as you'll see right here, we highlighted it, and you can see how the averages and everything is a lot cleaner at 21 DT, and how it makes so much more sense than holding all the way. When you look at, for example, your POP, which is going to be consistent, but if you look at your average daily P&L, that's where your big difference is. So your average daily P&L is going to be higher, your POP's going to be at the top, and your POP will stay consistent. That's your probability of profit. But where would you find the lowest C-bar, which is basically your outlier risk, worst 5% of the times, your lowest standard P&L standard deviation, that means how much is your account going to swing, your P&L going to swing every day, your highest average daily P&L, your essentially highest average P&L, and your highest pop. And that's right at the center at 21 DTE. So you can also, if you choose to, and you don't have very complex positions on, you only have like kind of, let's just say, one position or one strategy or one position in a certain underlying, you can manage at 50% of max profit. So if you put a position on, let's say that position just happens to work your way quite quickly, and you don't want to wait till half the time. If you put it on at 30 days, you don't want to wait till 15 days. You put it on at 5 days, you don't want to wait till 2.5 days. You can manage at 50% of max profit, because you're going to find very similar results at 50% of max profit than you do at managing at 21 DTE. Now, for those of you that are listening to this for the first time or kind of wondering, what the hell is he talking about? This will become second nature to you. The more trades that you put on and the more times that you do something and the more consistency, the more discipline, the more occurrences that you have, you're going to find that this becomes essentially second nature. In some cases, you'll use something like 50%. Other cases, you'll use 21 DTE. But one of the most important things here is whichever you choose, you want some consistency to it, and you always want to default to earlier rather than later. And that's the question we probably get most in emails is, should I wait a little bit longer? Is there anything wrong with waiting? And the answer is, of course not. But if you want to default to something, you want to default to a little bit earlier rather than a little bit later. And as you can see on this slide, we highlighted again that middle column, which is the 50%. So at Tasty, we manage at 50% of the initial credit or at 21 DT, whichever is easier. And if you have a nice profit and you want to take that profit before that, default to doing everything earlier, because defaulting to earlier is always better. So we have also applied these same guidelines if you are doing undefined or defined risk trades. Doesn't matter to us. Now, obviously, if you're doing undefined risk trades where you have outlier risk, which you don't have in the case of defined risk trades, but if you're doing undefined risk trades, these are the kind of things that would probably have a bigger impact and that would apply more often. If you're doing defined risk trades, okay, you have a little bit more wiggle room. And what I mean by that is the numbers become, there's less extreme. So if you want to wait a couple of extra days on a defined risk trade, sure, go ahead. If you want to manage a couple of days earlier on a defined risk trade, sure, go ahead. If you want to manage that defined risk trade at 25% instead of 50, sure, go ahead. If you want to wait till 75%, sure, go ahead. There's more wiggle room on defined risk trades because the early management of those, you're essentially, because you have a defined risk, you're essentially eliminating outlier risk anyway, which is one of the reasons for doing, for managing a trade early. But what should be pointed out is you still want to keep your size in check, because the number of contracts and the size of the position, whether it be capital or contracts, is really critical to the success that you're going to have. Whether it's defined or undefined risk, you want to keep that trade size small. And let's talk about basic portfolio management, because this is what tricks a lot of people up. Basic portfolio management, although it sounds easy at first, it's something that most individual or self-directed investors, it's not something they've had a lot of experience with. Now, after you've made a few thousand trades, a few thousand option trades, a few hundred option trades, tens of thousands of options trades, basic portfolio management becomes second nature. But getting yourself to the point where you're disciplined enough, where you create enough occurrences, where you don't have to overthink every trade and overthink every adjustment or every roll or every close, that's the hard part. That's what's so important about doing something. The experience of doing something 10 times or 100 times or 1,000 times, when you get to a certain number, it changes your results short-term and long-term forever. Something that never goes backwards. So for starters, let's talk about, position allocation based on the VIX. Now, everything we do at Tastylive, we will focus our context around what we're doing based on implied volatility rank. We call that IVR, implied volatility rank. However, when it comes to allocation and position sizing, to simplify things, we decided to use the VIX because the VIX is a little more universal. And if you are allocating positions in a portfolio, you're not going to allocate because every underlying has different IVRs. It's easier to find something that's more commoditized against an entire portfolio, which is the VIX. So what we did is we posted on this slide the most conservative case. Now we have a conservative case, we have a moderate case, which is 25 to 35% higher than this, and we have an aggressive case, which is 50 to 75% higher than this slide. So this is the most conservative slide. The moderate case would be, let's call it 25 to 50% higher, and the most aggressive slide would be 50 to 75% higher. That's why these numbers, where we currently are on the VIX, 25% allocation of a portfolio would seem low. But if you went to a moderate case, you'd end up with, somewhere between 37 and let's call it 42. And if you went to an aggressive case, you'd end up, between 50 and 60%, which may seem, again, more in line, but it also depends on your portfolio size, your net liquidating value. There's all this other stuff. For the purposes of today's discussion, we talk about kind of an average account size of, let's say, around $50,000. But we know some people have multi-million-dollar accounts and some people have accounts as small as $3,000 or $5,000. So it's hard to just, we can't make a blanket or we can't generalize. So for the purposes of today's discussion, when we talk about accounts, we talk kind of in that $50,000 account size. So we are going to, when we allocate trades, most of the time, we are in the 25 to let's call it 50 to 60% of net lick. We're somewhere in the moderate case. We also allocate about, and this is just a matter of preference, so I can only talk for myself. We allocate, meaning me, I allocate about 75% of my trades to undefined risk and about 25% to defined risk. And what we're also very careful to do is not to allocate more than a certain percent of a portfolio to a specific underlying. Again, diversification is your friend. Diversification of underlying, diversification of strategy, diversification of duration, diversification of volatility. All of those are important, and I'm going to explain later how important they are. But just so you see from an allocation side, a max allocation of, I do usually a max allocation of 75% to undefined risk and 25% to defined risk, but I'm pretty much in that 75-25 range all the time. And for my total portfolio, I tend to be in the 25% on the low side. I manage a large account, but 25% on the low side and 50 to 60% on the high side. For smaller accounts, you'll be between 50 and let's call it 80%. For large accounts, you more, for mid-sized accounts in that 40 to 60 range, and for smaller and for larger accounts in that maybe 25 to 50 or 60% range. So the benefits of diversification. Now, in a traditional sense, in the classic sense, diversification was always just different names, different underlyings, different sectors, different countries, whatever it is. That was classic diversification. But we all know now that based on correlation, stocks are stocks. And in an up move, they can go lots of different directions. In a down move, they all are highly correlated to one. So there is no real true diversification in equities, just the downside. So what we have to do is we have to get a little more creative than that. And we have to find underlyings that are actually not correlated. So we can diversify through underlyings, no question about it. There's no correlation between, for example, stocks and bonds. There's no correlation between stocks and currencies. There's no correlation between stocks and precious metals. There's very little correlation between crude oil, natural gas, and stocks. So there's lots of different ways to diversify by underlying. We can also diversify by strategy. And that's really interesting because none of us really understood that before. But there's a big difference between a strangle and a calendar spread. There's a big difference between, an iron condor and a ratio spread. In fact, you reduce your portfolio volatility, you reduce your outlier risk, and you increase your returns dramatically if you are able to diversify your portfolio. That means futures, that means options, that means different strategies, different underlyings, different implied volatilities. Some are going to be higher than others. Some are going to be, they're going to seem like they're super low, but the IVR is going to be high. Some are going to seem like the implied volatility is super high, but the IVR is going to be low, so you don't do them. You're going to diversify by durations. Some might be weekly, some might be monthly, some might be, 2 months out. And you're going to diversify sometimes by management style in the sense that sometimes you're going to go to 50% of max profit, and sometimes you are going to go to just straight at 21 days. I find with lots of different positions on, because I like to carry lots of positions, with lots of positions, the consistency, to get the best consistency out of my portfolio, I manage at 21 DTE because it lets me get out of everything at the exact same time. I don't have to worry about kind of exactly where is 50%. So the 21 DTE to me is really critical. So let's take a look at when we look at our Greeks. One of the questions that we get the most is, okay, well, I get all this. I understand, Tom, why you're saying, let's diversify the portfolio, let's manage early. But what confuses me is I'm not sure what too big really is. So one of the things that we talk about a lot is looking at what is a reasonable amount of theta, of premium decay, to create, because we want our portfolios, you can play the market two ways when you trade derivatives. You can try to beat the market, or you can let the market try to beat you. Our preference is to let the market try to beat us, which means we are always carrying positive decay, meaning we are letting the decay work for us, and our theta numbers are always positive. But how much theta should we have? Like, how much decay do we want? And it's always measured against our net lick. So how much theta decay are we looking for, and what's a reasonable number? Now, obviously, when implied volatility is really high and implied volatility ranks are high, you're going to let that theta number go up a little bit because there's more opportunity in high implied volatility. But what about what about markets like they are going into December? What about markets in the second half of 2023 when implied volatility was actually pretty low? Like, what's a reasonable amount of theta to our net lick? Well, on the low side, you want it to be around 0.1%. On the high side, you don't want it to get much more than 0.2 to 0.4%. Sometimes on a really small account, you can get to maybe 0.5%, 0.5%. But for the most part, you're going to be somewhere wrapped around the 0.1% to 0.3%. Smaller accounts will be closer to 2 to 0.3%, maybe 4. Larger accounts will be in the wrapped around the 0.1%, maybe 0.2%. Sometimes even 5 basis points instead of 10 basis points, which is 0.1%. So just if you're trying to think about, hey, where is that number? Well, it's 0.1%. So if you're talking about $100 account, you're talking about 10 cents in theta decay. I mean, obviously there's no such thing as a $100 account, but if you were talking about a $100 account, that's what it would be. You can multiply it out from there. But that's what we're talking about. So just to put some context around that seems like a small number, but it's not. I promise you it's not. So let's move into the next step up, which is advanced portfolio mechanics. Okay, advanced portfolio mechanics and strategy. Now we're going to take it up a notch. And at Tasty, one of the things we've done over the years is we've never dumbed anything down. We've always challenged. One of the neat things about entrepreneurship, one of the neat things about business, and one of my favorite things about trading is not just all the things you can pull out of trading, but it's all the challenges that evolve from trading. So one of the things that we start with is, understanding that, understanding how portfolios work. There are lots of things that can happen in the option world. There can be a directional move in the underlying. Your deltas can change really quick. Now, with 45 days to go, deltas move slow. With 21 days to go, deltas start to move a little faster. With 2 days to go, deltas are all over the place. They can go from 0 to 100 in a matter of seconds. So that's one of the reasons that you manage early, but understanding directional moves in the underlying, that's one of the factors that you have to take into account. The other is changes in implied volatility, changes in time to expiration, because it's going to matter to you once you understand this stuff. You're going to see the longer you go out medium term, the easier it is to manage the positions and the less risk that you have. And then what strategies based on the price of the underlying, based on the volatility of the underlying, based on the rest of your portfolio. Where do you want to be? Probabilistically, where do you want to be? So to do this, we started to put together kind of, let's call them some mechanics for determining kind of position size that would protect you against market-wide volatility expansion, and also to make sure that you develop the process of keeping your positions very reasonable. So how do we do this? Well, we limit capital allocation, just a generalization for that. Now, again, this depends on account size, but talking about kind of like a $50,000 account, and you can guesstimate it higher or lower. So obviously $1 million account is going to have significantly lower numbers than I'm about to tell you, and a smaller account is going to have slightly higher numbers. But on an average account size, if you're talking about a defined risk position, you're going to be somewhere around 0.5% to 2% of your net lick. It's always net lick, not buying power. It's net lick. So net lick is the value of your account. Okay, it's the mid price, it's the theoretical value of your account. Net lick, you're going to be somewhere about 0.5% to 0.2%. I'm sorry, to 2% of your net lick. So 0.5% to 2% of net lick for defined risk. For undefined risk, it's going to be 3 to 7%. Now, is it okay if it's 10%? Of course. It gets there. Is it okay if it's 2%? Of course, it gets there, because different stocks have, and different indexes have different prices. It's way different to trade a $20 stock versus a $200 stock. So the answer is of course, but these are generalizations. So for undefined risk positions, 3% to 7%. Now, the last thing here is you never want to have more than 15 to 20% of your net lick in a specific underlying. That's kind of your max. So if company XYZ or index XYZ has, you have a bunch of positions on in there, you don't want that to exceed 15 to 20% of your net lick. 3 to 7% for undefined risk, 0.5 to 2% for defined risk, and never more than 15 to 20% for a single underlying. And again, just remember, on the upper right-hand corner of this slide, page 134, it all ties back to all the math behind this. And the math behind this is really fascinating, but it all ties back to the math behind this in Julia Spina's book. So the next one we get to, and these are, Tasty is a think tank. Tastylive is a research-based think tank. And nobody has ever created this kind of option research for today's kind of high frequency based markets. And again, do the mechanics give you edge? Well, in a mechanical sense, yes. In a theoretical sense, no. But what they give you is consistency, and they optimize the mechanics behind all the numbers, because it's hard to go research, a statistic. It's almost like a cheat sheet card, if you're playing blackjack. Well, it's the same kind of focus here. That's what think tanks should do in the world of self-directed investing. Give you essentially a cheat sheet with respect to optimization of, how to address all these different circumstances that come up every single day. Because as we say, markets move. So what about the theta ratio? What about your theta ratio to your portfolio? We talked about this just a couple seconds ago, but what we want to do is you want to collect enough premium to justify the risk that you're taking. You want to collect enough premium to justify the tail risk that you're taking. And you also want that premium to reflect the current levels of implied volatility. But in the end, you also want to know that a reasonable expectation for the premium that you have sold and that you are collecting on a daily basis is about 25% of your extrinsic. So when you sell something for $1 and that's equivalent to, let's say, $100, a one lot at $1 is $100 worth of premium. A reasonable expectation for what you're going to keep of that $100 is about $25. That's with managing early. That's with making other adjustments. That's with combining losers with winners. And that's an objective. Okay, that's not a guarantee. That's an objective. So what we do at Tasty, and the way that we present our research at Tastylive is that we beta weight essentially all our discussions. And on the Tasty Trade software, they beta weight all your positions to the S&P 500 ETF, the SPY. So what we do in our research is we use the S&P 500 as the underlying basis for our research, and everything in portfolios have been normalized and commoditized by beta weighting everything to the S&P 500. This is something we introduced to the marketplace almost 24 years ago, and it's now become an industry standard. I mean, we introduced implied volatility rank, we introduced beta weighting to SPY. I mean, this is all stuff that has changed the industry, and they're all products of our research and of our technology that we've built over the last 2 decades. So as you can see here on the slide, we talk a little bit about, we also use the term neutral, delta neutral, and essentially what that means is we're not taking a directional shot. We're betting on premium decaying. So if you ever hear the term delta neutral, it means it's a non-directional play, and the bet is on volatility contracting. The other thing we do, and we're conscious about, is we will balance our capital according to POP. POP is probability of profit. POP is the probability of making 1 penny at expiration. So, you know, on Tasty Trade, the software, they offer kind of 2 versions of POP. One is the probability of making 1 penny at expiration. That is a pure theoretical model that's based off of Black-Scholes. It's how all options are priced. The other is P50, which is the probability of making 50% of max profit at some point prior to expiration. Your P50 is always going to be higher than your POP, but it gives you 2 different ways to look at your probability of profit. For me, one of the most important things is my overall POP. Like, what is my overall probability of profit on my total portfolio? Of all the different trades I make, if I do one at 80% and one at 70% and one at 60 or one at 54% and one at 92%, what is my overall probability of profit? And I think one of the things that we want individual investors to focus on is to always give themselves an opportunity to have a probability of profit on the total portfolio of somewhere around 70%. So we like to say 66 to 72% is kind of the target, and 70% is the objective. Well, 70% probability of profit's a theoretical objective. Why wouldn't everybody do that? And the answer is because in order to have a 70% probability of profit, you're going to risk more than you can make. It's a straight symmetrical math model. So if you want a 70% probability of profit, okay, you are going to take more risk than you can make. Now, in my world, I like that because a 50-50 probability of profit, okay, 50% probability of profit, 50% chance you make, 50% chance you lose, that's a 50-50 shot. I don't want a 50-50 shot. I want a 70-30 shot, okay? But doing that, I know I'm going to take more risk. I have limited profitability in some cases and unlimited risk. That's the trade-off, but it's theoretically perfect. One thing we like to remind people of and we like to caution people of is that concept of how much of my portfolio am I really going to commit? So if I have $100, is it reasonable to commit $30, $40, 50, 60, 70, 80, 90, 100? And the answer is, it goes back to VIX levels. It goes back to implied volatility rank context. But in general, if you have a large account, you don't want to go over that 60% number. If you have a smaller account, you know, you might be able to get up to 75 or 80%. And if you have an average size account, that's 60%, 70%, that number is about your max. Very large accounts, 50% is kind of about your max. The reason for that is because occasionally the market does things where, the crash of 1987, the meltdown in 2008, the pandemic in 2021, you always want to be able to come back and play the next day. And at that 60% allocation on average, you can always come back and play the next day. If you are committing capital to one-off or binary events, you want to be careful because there's very little management of those events and there's very minimal edge. So if you're playing an event-based trade, like a economic report, an election, a earnings report, some other kind of number, something else that's coming out, like a Brexit, for example. If you are doing that, just understand there's minimal overstatement, minimal edge, and very little you can do with respect to adjusting those positions. So you want to be careful and not let those positions get too big. I think in most cases, if you're doing kind of a one-day binary event, you don't want to get much more than 15 to 20% of your available buying power or 15 to 20% of your net lick. Traders often use 1 DTE or weekly as kind of as a guide for an expected move in those cases. Like I wouldn't use a 45-day expected move for an overnight earnings play, or I wouldn't use that for a one-day economic event. But if you're looking at a stock that doesn't have any numbers that are expected to come out or an underlying with any expectations of a binary event, then you're going to look to that 30-day. We mostly look to the 30-day IVR or 45-day IVR, whatever it is. Again, more details here on page 164. So for 0 and 1 DT trades, these are minimal edge trades, highly volatile trades. Just want to be careful. A couple of things to just remember. Try not to hold things past midday. Definitely try not to hold things into the last 2 hours. That's where you have the most amount of risk. If you're using a big index, that's cash settled, you might want to use defined risk. It'll be much more capital efficient. One of the keys to success is having enough, being smart about capital efficiency. And of course, most importantly, keep your position size small. So we're going to wrap up this segment with exploring your probabilities. And what's so interesting about this is there's no tells in trading, but there are things that we look at to get an idea of, with respect for the first thing is like pricing skew. So options have, ever since 1987, options have, there's pricing skew, which is what we call this level of asymmetry in the distribution of prices. In other words, if you're trading an index, like an equity index, you're going to find the puts are way more expensive than calls because the perception of the velocity of risk is to the downside. If you're trading a highly volatile stock with that has a lot of upside to it, whatever that stock underlying may be, maybe it's a biotech, maybe it's a precious metal, maybe it's the hot new IPO, whatever it is, you're going to find huge skew to the upside, meaning calls are going to be more expensive than puts. So what the market does is it prices the options based on the perception of where is the velocity of risk. That doesn't mean in the index products there's more risk to the downside than the upside. It doesn't mean in some biotech there's more risk to the upside than downside, okay? Or that the stock, I'm sorry, it doesn't mean that the stock's going to go higher. And to the index, it doesn't mean the stock's going to go lower. What it means is the perception of risk is those directions. What does that mean for you as a strategist? Well, as a strategist, it means, okay, I might, want to do something where I take advantage of that pricing skew because I know that pricing in the end is random. Just something to be aware of, not something that there's a specific takeaway other than awareness. I call it market awareness. So probability of profit is the theoretical probability of making 1 penny on a trade. For naked options, a cheat sheet way, back of the envelope way of doing it, if it have a delta of between 10 and 40, you can use those deltas to estimate the probability that the option will expire in the money. So if an option has a 25 delta, it has approximately a 25% chance of expiring 1 penny in the money. So the probability of profit is essentially going to be the inverse of the delta if you're selling that option. So I wrote it out in the slide. For example, a 25 delta put has about a 25% chance of expiring the money, meaning that it has a 75% pop for selling that put. For a spread, you divide the max loss by the width of the spread, and you're going to get the exact theoretical pop. So it's a little bit more discretionary. There's a little more wiggle room on a naked option, but for a spread, the theoretical probability is going to be spot on. So a quick little recap, because I can't get diversification out of my head. I know how important this is. Diversification with respect to time tends to reduce portfolio allocation if you use a few different expiration dates. You don't have to use weeklies necessarily, but sometimes you mix in, a daily, a weekly, or something a little bit longer than 30 or 45 days. Diversification with undefined risk and defined risk is so important. That's that 75-25 discussion we had earlier in this segment. Diversification with respect to underlying is probably still the single most essential function of portfolio risk management. It is critical that you look for underlyings that are not correlated. Our technology is very clear and our research is very clear about correlated underlyings and the benefits of using non-correlated underlyings. POP is a very important factor because overall portfolio POP gives you an idea and you can set reasonable expectations for your portfolio. And the whole concept of getting in a rotation, of getting into a methodology of managing your trades early, either according to days to expiration or according to a profit target, or just simply defaulting to earlier, is the most effective way to reduce P&L volatility and to reduce outlier risk on a per trade basis. Here's a couple of stats to end the discussion on that are really going to help you as takeaways. So the POP, your probability of profit, is going to remain the same. So don't be fooled by that, regardless if you hold to expiration or manage early. That's not going to change. But what does change is, compared to managing early, managing at the halfway to expiration or at the 50% profit, and these are three huge takeaways: nearly a 30% higher average daily P&L, nearly a 60% lower per trade P&L standard deviation. That's your volatility. You reduce by 60%. And nearly a 60% lower per trade CVAR. That's conditional value at risk. That is your outlier risk the worst 5% of the time. So essentially, you're taking 60% of your outlier risk off, 60% of your daily volatility, and adding 30% higher average daily P&L. Those to me are fascinating statistics and a great takeaway.
Hi, I'm Pete Mulmat. I'm here to talk to you a little bit today about futures trading. Starting to understand futures, put them to work for you, and you're going to be surprised at the power of futures and what futures let you do as an active individual trader. And that the jump from stocks, from options to futures, and that's usually the journey, doesn't necessarily have to be that journey. Futures could be part of your trading stable, your trading arsenal, your trading toolbox. They're important components, and we'll talk a little bit about how you best use them, how you put them to work, and how can you empower yourself to use them given what you're trading right now. So we'll spend some time on all those pieces. I've been trading futures now for over 40 years. I started on the floor of the CME in the currency pits. So I've traded currencies, everything from oil to energy to cattle and hogs and S&Ps throughout my 40-year career. And the efficiency, the liquidity, and the ability to express an opinion is really, futures are incredible. There's so many things you can do with them. So what are we going to talk about here is, as a trader, what do we look for? Well, we look for products that are liquid, products that move, products that give us, and we often, we use this term, we like to trade small, trade often. Well, there's a reason we do that. A diversified set of occurrences is so important to a productive trading methodology. And how do we diversify? When we add more products to the mix. What limits us from doing that sometimes? Well, the cost of adding more products, whether it be margin, buying power, or capital, however you want to look at it, that cost of diversifying strategies, diversifying across products is something that sometimes impedes our ability to get a truly diversified portfolio. Well, futures bring you efficiency. Now, I look at it, I refer to it as capital efficiency. Now, you've heard the term leverage used too. Futures are leverage. They are leverage, often used pejoratively as a kind of a negative connotation, but really it's capital efficiency. It's doing more with less. Now it's so important you understand what you're trading and the size of what you're trading, and make sure that you're trading the right size product to fit what your goals are and your strategies are. But futures afford you that efficiency. They give you that access. Now, futures have less slippage. They've got a tighter bid-ask spread. They trade 23 hours a day. And, you know, oftentimes people new to futures always will say to me, well, you know, that scares me, the 23 hours a day. None of us stay up all night. We can't manage our positions, you know, all day, all night. But what that does is that gives you the ability to trade markets, manage your exposure, and find opportunity when you want to, not the 8 hours a day that the world of equity gives you from 8:30 to 3 o'clock, but around the clock. So when markets move and opportunities unfold, you can take advantage of them with futures. So that access is so important to be able to get at product when you want to. Now, futures really around the clock have that liquidity, which is incredible. We'll talk a little bit about time zones and liquidities, but they are leveraged. So you are getting and really leverage is you're controlling more notional, more of the underlying with less capital. So that makes for a much more efficient type of trade. Now, what can we trade? Well, we can trade pretty much everything under the sun. Equity indexes, the S&Ps, NASDAQ, Dow and Russell. We could go over and trade interest rates, everything from 2-year notes to 30-year bonds. Energy, crude oil, natural gas, gasoline, heating oil, currency, euro, yen, sterling, cable, Australian dollar. All the currency pairs are there to trade. Metals, gold and silver, even things like agriculture, beans, corn, and wheat. You know, I get asked so often, well, why would I trade currencies? Currencies aren't necessarily something I trade. And I always ask people, well, tell me a little bit about what do you have on? What's your exposure and how are you diversified? And they go, well, I've got some Apple, got some Tesla, but I also have some GM, I've got some Ford, and maybe I've got some USO for crude oil. But you know what you have? You've got a lot of dollar exposure because every product we trade in the States is priced in dollars. So you have a ton of dollar exposure. Looking, as we talk about, trading small, trading often, and most importantly, a diversified set of occurrences. And why that's important, we're going to talk a little bit about. You start to diversify away, you create a consistent set of returns. And one way to do that is to take some of that dollar exposure out. So all these products can fit into that world of capitally efficient trading, giving you pure product exposure 23 hours a day. Now, what I love, one of the things I love about futures is that they're a neutral security. What do I mean by a neutral security? It means you can buy it or sell it with equal ease. Now, we know selling stocks short is a little bit of a challenge. You've got to borrow the stock. There's a cost to it. Other products are difficult to sell short. So they're not neutral securities. There is a little bit of difficulty, complexity, and cost trading one side of it versus the other. So with futures, you could trade either side of the market, long or short. It's as simple as buying or selling. There is no additional margin. There is no additional commission. There's no additional costs either side of the market. What that does is it frees us to make decisions, find strategies, and put our ideas into play at that same low and efficient cost. Very important aspect. So, that concept of how can I sell something I don't own? It's very simple. With a futures contract, it's a futures contract. And what I mean is it's a contract, not the good itself. So you're not buying or selling corn. You're not buying or selling crude oil. You're buying or selling a contract for future delivery. So you can sell it as easily as buy it. And there is no delivery. There is no worrying about 1,000 barrels of crude oil being delivered to your backyard. Everything is handled. Most products we trade are cash settled. The ones that aren't, there's a very clear mechanism to make sure that as self-directed retail traders, we're not involved in that physical aspect of delivery. Now, buying power, this is what I'm talking about when I talk about capital efficiency. What does it require? What do I need to put up to control a contract? Well, there are big contracts and there are micro contracts. You can put less than $300 to control a micro contract in futures. Now, going through some of the big ones here, S&Ps, crude oil, gold, T-bonds. Now we see crude oil, the buying power there is $18,000 on a big crude oil contract. There's also a micro crude contract at a 1/10 the size. You look at Euro. Now Euro USD, that's 125,000 euros, almost $150,000 of exposure. You would think, why is something with so much exposure have such small buying power? It is the volatility. Futures margining is different than the world of equities and options. In the world of equities and options, we basically have Reg T. So we've got 50% margin for most of us, or it's full cost. In the world of futures, there is something called span or dynamic margining. What that does is it looks at movement, it looks at volatility, and it assigns what the model constructs as a good faith deposit, what you need to deposit to hold that product, either long or short. So the higher the volatility of the product you're trading and the larger its notional size, the more margin you'll be required to post. Does margin change in futures? It does, but over time, it doesn't necessarily change day to day by dramatic amounts. So you will see as volatility ebbs and falls, margin will rise and fall for a certain product. But what's great is you really get that efficiency of if you're looking at products that are not trading with a lot of volatility, that have a lower vol structure, like currencies always have a much lower vol structure than something like gold or crude oil. So we would always see a lower structure and per notional, a lower buying power in the currency futures than we would say a crude oil or a natural gas future. That helps us with product decisions and sizing as well, is understanding what is the capital requirement, what is the volatility, and what's the expected move. So higher vol, higher margin. As we said, buying power rises with volatility and product size and vice versa. So we can see here, the volatility is along the second to the right rail there, and we see the margin rate. So lower volatility, lower margin. And that euro margin is only 2% of the underlying, where we see it at 17% for crude oil. So this dynamic margin model is another way we gain efficiency with using futures. We need to understand that volatility is the driver of that and be mindful when we select product and when we select strategy, we understand that component. But it is one way where you really get to right-size your trade, right-size your strategy. You know, in something like crude oil with volatility where it is, maybe you go, instead of a 30 delta strangle, you're going to a 15, a 10, or a 5. That's your choice to make. But with futures, you have that flexibility to do so. Now, higher leverage is really important when we look at what we can do with our capital. You look at shares being margined at 50%. Options, we'll just use a ballpark at 20%. And futures margin between 1 and 20%. You can see and really think a little bit about time frame. Where does this very efficient capital market or this very efficient product exposure really serve us best? It's in some shorter term trading, not our necessarily longer term or core positions, but shorter term back and forth is where capital efficiency really resonates for all of us. Now, we talked about trading small, trading often, and trading a diversified set of occurrences. Why is that so important? Well, we're going to talk a little bit about the law of large numbers and how that really works with a diversified set of occurrences. What futures give you. Now, we know in the world of stocks, and we looked at 4 equity indexes earlier on, S&P's, NASDAQ, Dow, and Russell. Are they perfectly correlated? Absolutely not. Are they positively correlated? Absolutely. Probably north of 80%, if not closer to 90 on some of the pairs. When I'm long Russell and I'm short S&P, or I'm long Amazon and I'm short Tesla, do I have one product against another? Absolutely. If I am long a set of equities, do I have diversification? You have that first level of diversification. You started to move out from one underlying to several, but you're still into a highly correlated asset class, which is equities. By moving into futures, you're moving into uncorrelated returns. And that is so important. Let's take a look at the correlation map here and we can see what we're talking about. When we go through the asset classes, we can start up in the upper left-hand corner here. S&P's, NASDAQ, Dow, and Russell I mentioned. That's ES, NQ, RTY, and /YM is Dow futures. Now, the green boxes are all positively correlated. But what's fascinating and what really speaks to the value of adding futures is diversification along with capital efficiency. When we run between equities and metals, or we go down to the ZT, ZF, ZN, those are treasury futures, or down to the currencies below, 6E, 6B, or even crude oil and natural gas, we see little or no correlation or a negative correlation. Now we're starting to get into the area where if we can size product properly and we can trade it in an efficient manner, we are really moving to that next level of diversification, which is so important to be able to do. So I had mentioned the law of large numbers. I want to talk a little bit about that right now. Now, your average occurrence will reach the expected outcome as the number of occurrences grow. And if those occurrences, this is the key point, are independent, non-correlated occurrences. So if we have a strategy, whether that be one based on probabilities and statistics or technical analysis or whatever you find that works for you, that idea of an independent set of occurrences lets you find that true return if you employ if you use futures to find that diversification and start to move to those type of outcomes. So the law of large numbers will play in our favor as we move using futures to do so. So let's talk a little bit about liquidity. There are 3 major time zones with futures. There's Asia, Europe, and the US. Now, as I said, futures run 23 hours a day, 5 days a week. So the US time zone, we're going to find tons of liquidity from 7 in the morning all the way through when futures close at 4 in the afternoon. These are central daylight times. Asia picks up at 5 in the evening our time. And it'll be a little thinner for the first hour or two. It'll just be New Zealand and Australia. But as the rest of Asia comes in, the markets continue to grow and the volume and the depth of book continues to expand all the way through Europe back into the US. The clock never stops going, so that liquidity is always there. Now, at certain points of time, and depending on certain product, you'll see greater depth of book, greater liquidity than at other times. You need to be mindful of that, but you always want to look at a product before you start trading it. You want to make sure that liquidity is there, that bid-ask is tight, it's consistent, and there's depth, whether you're trading futures or options on futures. You want to understand the construct of liquidity, because remember, when we look at costs, what are our costs? Well, we know there's commissions, there's fees, but our greatest cost of trading is slippage, the bid-offer spread. A tight, efficient market, one tick wide, 50 or 100 up, lets us trade in and out all day long with as little slippage as possible. Critically important. We want to be always be mindful that we're looking for products that are liquid and very efficient. So let's take a minute and do a little bit deep dive into a couple of trading strategies we can look at where we can use probabilities to take that 50-50 coin flip of trading futures directionally and also take a little bit of a look at options on futures. Now, If you're an options trader right now, trading equity options or ETF options, you've got your mechanics down. You know when to trade, when to manage, what to look for in terms of volatility. Now, do options mechanics apply? Do your existing ones apply? Absolutely. IVR, management, et cetera, they all apply. Do futures options cost less? They are more capitally efficient. So the cost of capital or the cost of holding that position is less. So it is a more efficient trade. You're gaining more efficient exposure using futures than equities or stock options. Is IV different for SPY versus ES? No, the markets are very, very similar. When do you roll futures options? Just like stock options, 21 days to expiration. We look to put them on at 45. We look to manage them at 21. How big should each trade be? Important component, because remember, we're using leverage, and we're using capitally efficient leverage, which can give us more exposure for less money. We want to understand that. Margins should be less than 5% of net liquidating value. So we want to make sure that we can have a diversified set of occurrences. We don't want to overcommit to one product. What should your futures allocation be? This depends on the trader. Now, mine usually sits a little bit higher than average. I trade a lot of futures, but I would say for really a diversified portfolio, you're looking at your futures should be 20% or less for your overall portfolio. Now, the strategies you can employ using SPY and ETF on the S&P or ES futures, which are the S&P 500 futures, same strategy, but the capital efficiency here I want to speak to a little bit. A SPY strangle, you're going to generate a credit of about $375 on this strangle. It's going to cost you about $130,000 to put that strangle on. Now, you're going to go put on an ES strangle of equivalent width at the same deltas. That credit's going to be about $1,800. Why? Because you're controlling more notional, but the buying power on that trade is going to be $17,000. Why is it so much less? Different margin model. So it's understanding that the efficiency and the capital usage we do in futures is different than we do in the equities world. It's more efficient. So we're going to take advantage of that and be mindful, though, that what do I have on? I've got a trade that is more capitally efficient, but also a bigger trade. So this is the case where I want to be mindful of what size exposure do I have, and is it the right fit for the balance of my portfolio? Very important questions when we go through. Now, we'll talk about trading volatility and taking advantage of high IV, and this is something we focus a lot of time and energy on. Now, scalping, which is just the directional buying and selling of futures, can be a substitute for trading volatility. Trading back and forth, inside price action, buying lows, selling highs, turning product back and forth. If the markets are liquid, if the products are right size, which means a suite of minis and micros for smaller traders, you always have benchmark trader products, bigger products if you want, but those efficient liquid markets let you trade back and forth very easily, very efficiently, and 23 hours a day. So they are another way to trade and benefit on a short-term basis from inside price action, back and forth. Now, we talked about the directional trade, and I am a believer in the random walk, and that there is no guessing as to what the next trade's going to be. It's a coin flip. And what we do want to do, though, is what I like to do is take a look and see how I can take probabilities around statistical movement. And can I use those probabilities to tilt the 50-50 bet a little bit in my favor? And if we take a look at the idea of standard deviations, and how can we use standard deviations to help us find trade location around markets that give us a statistical edge, this is something that I think everybody's going to find really interesting. Now, we know that a one standard deviation move happens 68% of the time in a particular market. A two standard deviation move only happens 5% of the time. Now, 95% of the time, the market stays within that two standard deviation range. And remember that standard deviation is determined by in dollar amount, the size of the product, and its volatility. So different products have different standard deviation widths. One standard deviation in the currencies and something like EuroFX could be 40 ticks, where one standard deviation in crude oil could be $3 or 300 ticks of range. So what's great though, using standard deviations, it kind of normalizes that. You don't have to worry about tweaking it. If you use this methodology, you can really kind of break down what is a normal day, what's an inside day, what is an outside day, and start to build strategies around that. And the standard deviations will be your guide to where that is for each product, because each product will be a little bit different. So when we look at the normal distribution, we know where that falls. One standard deviation, 68%. Two standard deviations, 95% of the time the markets come back in. So can we use this to day trade around? Absolutely. If we take a look and we just pick any point of the day and we say, I'm going to be long or short, we know that coin flip comes into play. And what that's telling me is that I've got a 50% chance of being right and a 50% chance of being wrong. But if I go and take a look at the idea around standard deviations, and I wait for that one standard deviation move during that day, I have now taken, I'm using that as an entry point, either to buy or to sell. And I'm looking for reversion to the mean. I've now taken that 50-50 bet, and over the long run, remember, it's always over the long run, I've now increased my statistical probability to 68-32. If I wait for a 2 standard deviation range, what have I done? Well, I've created a trade with a 95% probability of reverting back towards the mean. Not necessarily all the way, but towards the mean. Now, let's not forget though, we're turning the odds from 50-50, but we're never going to turn them to a perfect situation where they're 100%. So that 68% trade still means 32% of the time I'm going to be wrong. And this is where symmetrical loss management becomes important if you're scalping with probabilities, which is what I use. So if I'm going to look at this one standard deviation level to get in, and I'm going to take that 68% probability, I'm going to look to manage on a reversion of about half a standard deviation. But if I'm wrong, and say market got down there, I bought and it continued to fall, I'm going to manage that loss at about half a standard deviation. So what I've done is taken that entry and exit point and made them symmetrical. So basically 50% on either side. But my trade itself is put on at a 68% level. So that is where my edge comes from. Consistent management around symmetrical gains and losses lets you take advantage of the probability trading we're talking about here. So this sets up for being able to enter and exit trades during the day on a scalping basis, taking advantage of the efficiency of futures across a number of different products. Manage your profits and losses symmetrically. That's the key here, because if you do let them go, you create unsymmetrical returns. You've now destroyed your probability that you've turned in your favors of with your standard deviations, and you've also, your consistent independent occurrences we talked about with the law of large numbers now is no longer in place. So you need to be mechanical, just like we are in options. Scalping futures, same thing. We need to be mechanical. We need to be aware of where the statistics lie, the probabilities lie, and take advantage of those. And that will give you some really interesting tradable opportunity. Now, standard deviations are at the core of almost every futures strategy, like IVR is for options. So, and this is what I was talking about. Depending on the volatility, crude oil, 2% up or down is about one standard deviation. S&P is about 1%. Currencies, much smaller volatility. Term structure, it's only up or down about 0.4%. So these are very straightforward. They're very easy to determine, and they are the great equalizer for using probabilities to trade across a number of different products. So consistency is always key in the way we allocate, the way we trade, and the way we manage. Diversified strategies and occurrences have to be disciplined and consistent for us to see positive results, positive returns. So set mechanics and stick with them. I like to look at about 15% of my trading, 15 to 20% in futures or futures options. I manage them around half a standard deviation. 35% are stock options, which we like to manage at around 50%. And Then I've got a core position of a number of different things that I'm holding for longer term strategies. So that's kind of the breakdown of the way I like to look at bucketing how futures fit. And the one thing, guys, I want you to think about is for a lot of us, there was always, and I was actually a little different. I started trading futures very young and have always traded them. But there's usually a kind of a normal life cycle of trading equities, then moving to options on those equities, options on the, and then futures. Now, there's nothing that says for the self-directed trader that he's got to take that journey, that I have to take this journey of no leverage to a little leverage to some leverage to more leverage. If I understand the products and I have consistent and sound methodology, I'm product indifferent. I don't care if it's a future, if it's an option, or if it's a stock. If there's an opportunity, I want to take advantage of it. And that's what's so important. So when you think about futures, think about them as this efficient tool to fit in to your existing strategies, and that it doesn't require you to run down a certain learning curve. You obviously need to understand the product, the size of it, and the way it ticks. But in terms of implementing strategies, whether that be options or scalping strategies like we talked about, it can be very straightforward and very efficient for you to do. Just stay consistent. I hope you walk away understanding futures a little bit more, the power of futures and how you can put them to work to create a diversified set of occurrences and really find some new trading opportunities for your portfolio.
Hello, everybody. We're back for the second half of the futures segment of this four-part series. I am following up Pete Mulmat, who is our futures expert at Tastylive, and he's probably the person. I don't think I've ever met anybody that knows more about the futures markets than Pete. He's a third generation futures trader, and his fourth generation, his son, is actually working for us on our trade desk. So Pete's just incredible ball of knowledge from start to finish, historian as well as a very active trader, and an unbelievable resource if you ever have any futures questions or just industry questions regarding, the futures or futures strategies or futures products and things like that. So again, my name is Tom Sosnoff. I am the founder and CEO of Tastylive, and let's take it from here. I've got a nice presentation for you. It's kind of the final piece to this four-part puzzle. We covered, Jermal Chandler and myself covered the option side, and Pete Mulmat and myself are covering the future side. I'm going to take you through a discussion of futures, of allocations, of the way the product structure is done or built, and then also through a whole pairs trading discussion, and then end with a little bit on expected move and probabilities with respect to futures. So I hope you enjoy this, and here we go. So just to give you a little bit of background on me, if you just coming in late or missed the first part, I was a market maker on the floor of the CBOE for 20 years before we built Thinkorswim, and then before we built Tasty. So that's kind of my 4-decade career. But I use futures as for my entire career, I've used futures as a combination of a scalping tool, a speculative tool, and as a hedging tool. And I think there's now a lot more modern uses. That was kind of before the world went fully electronic and fully high frequency. Today, I use futures as a scalping tool still. I use futures as a directional tool. I use it as a pairs trading tool, which didn't really exist back in the day where I was a floor trader. And occasionally I'll use futures as a hedging tool. But I think the gist of today's discussion is really focusing on futures as an offensive tool, not as a defensive tool. And I should be clear about this at Tasty, we tend to, and I can just talk about my own trades, we tend to be about 75 or 80% listed options and about 20 to 25% futures trades. And there's a reason for that. First of all, the futures marketplace is not correlated to the equity marketplace in the sense that, of course, there are equity indexes in the futures world, but the majority of futures products do not have a heavy correlation to stock products, which makes them a really nice diversification tool. The other thing is futures use span margining, and equities use SEC-based and FINRA-based margining. So equities are about 6 times less capital efficient than the futures margining system, which is called SPAN, S-P-A-N. SPAN margining takes into account volatility. It takes into account duration. It obviously takes into account expected move, which is volatility, but it's much more liberal. It's much more generous intraday, and it is much more generous overnight. Now, it changes. It's not static. It's a dynamic margining tool. But what makes futures interesting, specifically futures options, is the high amount of leverage and the way you can combine that leverage with an equity portfolio. And I think that's one of the points that we're going to try to kind of drive home today. So I'm going to start off this discussion with a segment I call managing futures. And I talk about it and how to allocate and manage futures positions. The allure of futures is that they are the lead product in the market. So when you look at a screen, a watch list, if you look at see what the market's doing, when you are a passive investor, you really have no idea what futures are. When you are an active trader, the futures drive the cash markets. Cash markets are the equity markets. The futures markets lead the cash markets. Why is that? It's because the futures markets have much more depth of liquidity. They're 1 tick wide, and they have this huge pool of liquidity, and futures have all this additional leverage. So you go to the product with the deepest liquidity and the most amount of leverage, and that becomes, for example, index futures. So if you want to know what the market's doing, you'll always look at the S&P futures. I know that sounds kind of weird, but that is the nature of the business on the active trader side. So the first thing most people do when they think about futures, they think about, okay, I'm going to use this to scalp with. I'm going to use this to hedge with. But ultimately, you're going to learn, and we do this at Tasty, we trade more futures options than we trade individual futures. As crazy as that sounds. So the first thing is we're going to look at what I call direction versus duration. And one of the things that I've tried to do over the years with respect to futures is to create a variety of strategies and to do a ton of research that allows us to extend duration of future strategies and futures trades, because if you can extend duration and give people time to be right, you can put them in a position where they have a lot more optionality about making money. So first thing to note about futures is, like I mentioned before, is the leverage and liquidity of futures makes them the best scalping vehicle in all of trading. They are the underlyings themselves are very one-dimensional. They're static. You buy them if you want them to go up, you sell them if you want them to go down. There's nothing else to it. There's no premium decay. There's no theta involved in the model. They use the same, when it comes to the options, you'll see they use the same Black-Scholes model, the same pricing, same volatilities and everything else. But futures, as a pure static scalping or directional vehicle, the beauty of them, 24/5, so there's no, markets don't really ever close, and the liquidity is there around the clock. Price discovery wise, you're going to see it's basically 1 tick wide. That makes them incredibly attractive, and most of the futures underlyings are 1 tick wide as well. So the real value, though, when it comes to scalping futures is engagement. And engagement comes in the form of number of occurrences. Engagement is all about how many occurrences can I create, because with each occurrence comes a decision. And with each decision comes, it takes you to a different level of understanding and a different level of confidence, and it increases your brain processing speed, and it increases your decision-making speed. So it increases your ability to make to make efficient, probabilistic decisions, and at the same time, it increases the speed of those decisions. And success is all a byproduct or is all a derivative of speed. The odds of success when you're just scalping futures, and I've been doing this for over 40 years, and I can tell you even to this day, and I've been watching futures essentially every minute of my life, which is both scary and sad, but also good, I guess, in other ways. The odds are 50-50. Whether you love it, you hate it, you think that's crazy, you think you're better than that, whatever it is, it all comes down to being essentially around 50-50. It all comes down to trading small, trading often, which is kind of the mantra at Tasty, and also be really careful when using stops in the futures marketplace. I've never been able to see it. All our research confirms it, that stop orders are a very, if not the most dangerous order type. If you are going to use stop orders at all with futures and with stocks and with options and spreads and anything else, please only consider stop limits. Never use a marketable stop order. That's just dangerous to your health. Stop limit orders, that's the only way to go if you're going to use those at all. We don't use them at all. We use mental stops, but not what we call hard stops. But anyway, that's my first just quick discussion of scalping. I'm not going to spend a lot of time on that because that's not something that I don't know if that can be a learned skill. I don't know if that's something that anybody can ever, quote, master. Maybe a very small percentage. But with respect to trading futures, I think the important thing is to always remember a couple things in the back of your head. First, stay small. And if you forget everything else, just remember, stay small. So with respect to futures, they are a large notional contract. And again, when it comes to future size, if you're ever in question or something like that, stay small. In the industry-wide, the average number of futures contracts that trades is only like 1.5 or something per order, because they're almost 10x the size of a traditional options trade. Also, when you set up your software, whatever software you use to trade with, when you set up your software, set your trade size to a minimum tranche size. So if your tranche size for, let's say, listed options is 5 or 10, your tranche size for futures should be 1. It's not the same thing. If you're trading, 1,000 shares of stock or 100 shares of stock or 500 shares of stock or 5,000 shares of stock, you still set your tranche size for futures at 1. And then you can, obviously scroll up and adjust it accordingly. But that should be your minimum. You always set the minimum tranche size because with futures, they are big contracts. With micros, you can do that differently. You can set your tranche size to 2 or 3 or 5 if you want. But you generally, if you're trading micros, 1, 2, 3, or 5. If you're trading the minis, 1 contract. Micros add a lot more flexibility. The only thing you have to be careful with respect to micro futures contracts is just the option side of those things. The option side of micros can be very thin and might not trade, it might not have the open interest or the volume or the liquidity that you're looking for. But on the mini side, they'll have it. On the micro side, maybe not. With respect to the futures themselves, all the micros are essentially liquid. So on the future side, the minis and the micros are all liquid. On the option side, the minis tend to be more liquid than the micros for options. And so just be very conscious of that, be very aware. And also understand that the deltas work the same way. If you're doing a 50 delta option on a mini contract, it's the equivalent of 5 micros. If you're doing a 10 delta contract, it's the equivalent of 1 micro contract in most cases. In most cases, micros are 1/10 the size of the minis. So the micros add a lot more flexibility, but always stay small and always go to or always use the minimum tranche size. It's really important. Now, let's talk about futures options versus futures. Strategists, and I consider myself a strategist, strategists prefer options because of the different durational choices, because of the different strategic choices, because of all options offer you just so much more, I hate to use the word, but optionality. Options offer you so much more strategy. Options are this gray area instrument, and they allow you to trade in ways that are essentially, in some cases, non-directional, in some cases, what we call omnidirectional. For self-directed investors, 95% of futures trades are offensive, not hedge trades. Hedge trades would be traditionally, like, for example, the counterparty or high frequency firm might make a couple of trades in an S&P index, and then they'll hedge it with S&P futures. Or they might have a portfolio delta, and they'll hedge it with index futures. Retail investors don't really do that. Retail investors are focused on using futures. Like I said, 95% of the time, it's offensive, meaning that future strategy, that's your objective. You're not using the futures to hedge a position. You're using the futures as a position, whether it's futures contracts themselves, straight out, whether it's directional, or whether it's using options. 95% of opening futures trades are offensive and not hedges. Be aware, and this is the one, there's a couple things you have to be aware, but one of the most important things to be aware of is that futures are a nuanced product. I know Pete touched on this, but futures they have nuanced know-how. Futures are no different than stocks, than stock options, than any other asset class. It could be digital assets, it could be anything else. They're just another asset class. The difference is with futures, they have non-standard multipliers, which means one point in one contract might be worth $50 in one underlying, $20 in another underlying, $100 in another underlying. And so we call those non-standard multipliers. Why do they have those? I don't know. I mean, it's just the way they've been doing business for, 100 years or however long it's been. So that is the only thing, is that they have non-standard multipliers. We hope at some point they all go to standardization and a straight decimalization and standardization of multipliers. But right now, if you trade, no matter what listed stock option you trade, a dollar is a dollar. A dollar in IBM is the same as a dollar in NVIDIA, is the same as a dollar in Google, is a dollar in Microsoft, is a dollar in Apple. Okay, it's all the same. Or it's a dollar in ExxonMobil. But if you trade different multipliers, like you trade options in the NASDAQ futures, it's $20 a point. If you trade options in the S&P futures, it's $50 a point. So different underlyings have different non-standard contract multipliers. And that's the only thing you kind of have to get familiar with. That's nuanced know-how. Futures, and this is just an important thing to know, most futures contracts, not all, but most futures contracts are approximately 10 times the size of most 100-share ETFs. So in other words, let's say you were, and some of them are a little nuanced again. So for examples, if you were trading the S&P 500 or the spiders, for example, the spiders are 1/5 the size of the S&P E-minis. That's the regular ES. If you were trading the NASDAQ futures, there are about 800 shares of the QQQ. If you're trading the SPX, which is the cash, it's the equivalent of 1/2 of a contract of SPX. So it's not the same all across the board. And that's the only confusing part about futures, is that they have non-standard multipliers, or that's the most confusing part, is they have non-standard multipliers, and they're approximately 10 times the size of most ETFs. Not exactly, but approximately, because each one's a little bit different. So I thought I'd give you a couple examples here to show you. So ES, which is the most popular and the most actively traded futures contract, ES, and the micro contract is MES, super simple. The ratio of notional values is 10-to-1. In CL, which is crude oil, and the micro in this case is MCL. It's 10-to-1, meaning it's 1/10 the size. In GC, which is gold, the micro is MGC, and it's 1/10 the size. And in 6E, which is the euro, because people do like to trade currencies, 6E is the euro, and M6E is the micro euro, and it's 1/10 the size. So that's in general, kind of just to give you an idea of the micro contracts toward the regular contract, which is a mini, and the micro contract in these cases is 1/10 the size. These are 4 of the most actively traded minis and micros, just so you can see. So there is some standardization, but there could be other ones that are a little bit different as well. So as an option, I like to consider myself as an option trader. Futures options and equity options are about 94% of all the stuff that I trade. The rest is futures, stocks, and digital assets. So what's important to take away here is there is little or no difference when making an intra-month delta adjustment using futures options compared to equity options. So in the first part of our presentation today, if you went through the equity option piece and you learned to manage early, you learned to diversify, you learned what expected move was, you learned takeaway of some of the strategies. There is no difference in the roll forward piece. There is no difference in the adjustments we make. There is no difference in the manage at 50% of max profit. There is no difference in roll at 21 DTE. We use the same logic, the same mechanics, the same IVRs, like IVR has to be over 30. We use the same duration cycle. Optimal is 45 days to expiration. The math model, the variation of Black-Scholes that we use, which is the math model that supports all our futures and futures options trading and all our option trading, is the exact same for futures options and for listed equity options. So we use the same logic, the same mechanics, the same IVR, and the same optimal durations for futures options and regular listed options. And that's something that a lot of people get scared of, which makes them a little apprehensive about using futures options. And we want to just nip that in the bud. You know what? Don't worry about that. Use the exact same mechanics. All the optimal mechanics stay the same. So the rule for equity options, and does it apply to futures options? So sell premium when the IVR is over 30. Yes. Manage options at 21 days to expiration. Yes. Sell closest to 45 days. That's when you're opening a trade. Yes. And roll the untested side when the short options are tested. Yes. Everything that we do, mechanical optimized rules for equity options are applied to futures options. It's the same game. Different underlying, different margin structure. The only thing for us is, as self-directed do-it-yourself investors, is greater capital efficiency and more leverage. Greater capital efficiency with futures options and more leverage. So that means if we're successful, our returns are going to be magnified and they're going to add alpha to our equity returns because of the additional capital efficiency of futures options. I've done a couple of different pieces on this over the last couple of years. We actually used to do a full seminar on futures options, just talking about how additive they were for portfolio returns. And in some cases, it can add as much as 35 to 50% of total portfolio returns just with the additional leverage. Very interesting. The reason people don't do only futures options is because there's a very limited universe of underlyings. It's somewhere between 7 to 10 that really are liquid enough to trade. The other ones are just, the markets are a little thin for us. But where there is one tick wide price efficiency, which means wherever the mid price is, you move it one tick, you're filled, is about 7 to 10 different underlyings. And that's also during trading hours during the day. At night, the liquidity goes down a little bit, meaning the overnight sessions. It's usually just 2 or 3 different ones. So rolling futures positions. Now, the optimal time to roll futures options is 21 DTE. The optimal strike to roll to when you're rolling futures options, because this confuses people, because futures are not perpetual. So if you look at, for example, take a stock like IBM. IBM doesn't change. The IBM is the underlying. And so therefore, the stock doesn't change from one expiration cycle to the next. Futures expire on a quarterly basis, and each quarterly futures expiration is tied to a different underlying. So you can have, because futures have what we call cost to carry. In some cases, they have dividends built in. In other cases, they have a cost to carry built in, because there is no, quote, margin on futures. So the cost to carry that basket of stocks or that position is built into the futures price. So they could have this quarter's futures, which may expire in December. The next quarter's futures, which expire in March, may be $20, $30 higher, maybe $2 higher. It depends on the underlying. So what you do is you roll to the same delta, not necessarily the same strike. That's the only nuance difference. So when you're rolling futures options, you roll to the same delta. You do not roll to the same strike. And the only time to roll futures is when the active month officially becomes the front month. How do you know? You will either get an email or a note from your brokerage firm, or you will get on your watch list. The month will change on your watch list automatically for you. At Tastytrade, they change the month on the watch list for you, and they send you an email letting you know the futures are rolling. Can't speak for other firms. So allocations based on net lick, because I think this is important. So the first thing to know about futures or options or everything else is that we are product indifferent. We have started a crusade, almost 13 years ago with respect to product indifference. We don't want people to think, oh, I'm a futures trader. Oh, I'm an options trader. Oh, I'm a stock trader. Oh, I'm a cryptocurrency trader. Oh, I'm an FX trader. There's no such thing anymore. Everybody, I grew up in this business as an option trader, but you know what? Today, I'm just a trader. I trade any product. I'm completely indifferent to product. You have to be indifferent to product because opportunity is indifferent to product. So in 2023, we are all product indifferent. Wherever the opportunity is, wherever the capital efficiency is, that's where we go. And that allows for more trades. That allows for different types of allocation. And again, wherever you can find the most capital efficiency, that's where you'll go to make certain trades. Span margin provides up to 6 times the leverage of traditional equity margin, which again allows for more occurrences, allows for more capital efficiency, and it allows for better diversification and more total positions in a portfolio. You use with futures a much smaller contract size due to the higher notional value. So what gets confusing is if you were to trade a 5 lot or a 6 lot or a 3 lot or a 10 lot of listed options, you're only going to do one contract of futures options. Okay, that's the difference. So smaller contract size due to higher notional contract size. But remember, you're getting about 6 times the leverage in the overnight futures positions than you are in a listed option position. And I'll show you that in a couple seconds. What we usually say is we're going to commit significantly less capital to futures and futures options. In a total portfolio view, that number might be 20 to 25%, as it's not going to be 50 or 75% of total capital allocation, just because of the greater leverage, the greater margin, and you're protecting the franchise. You're always protecting the franchise. Individual futures options positions should use 30% less capital than similar equity positions. That's just how you allocate the capital. So if you're allocating, let's just say you're allocating $10,000 to equity option positions, you don't want to allocate much more than $5,000 to $7,000 to similar futures options positions. The per trade size should be limited to 2 to 4% of net lick, but in many cases that's going to vary based on the underlying. And I say 2 to 4%, because that's just about 30% lower than we talk about for equity options. But here's the most important takeaway from this particular slide, which is that futures allocation in a balanced, self-directed portfolio should not exceed 20 to 25% of your net lick. You stick to those allocations, you're just about perfect on the futures portion of your portfolio. And to give you a little idea about, this is one of the coolest things about futures and futures allocations based on net lick, because the fact that you span margin, it's a little bit different than the equity side. So on the equity side, for example, if you trade a kind of like a stock with high volatility, or you trade a stock with low volatility, the requirements based on the price of the stock. So high volatility stock is going to have the same capital requirement by definition as a low volatility stock, meaning you're going to be taking a lot more risk with a high volatility stock than you would with a low volatility stock, but you have to put up the same amount of capital, which doesn't really make much sense. It's a little antiquated, it's a little outdated. In the futures world, it's different. So as you can see here, the S&Ps, they require about 13-to-1 leverage. And leverage will give you an idea of what risk is. Where you have lower leverage factor, you have more risk. So crude oil is 7-to-2. That shows that crude oil is much riskier than S&Ps. The euro is 38-to-1. The euro is essentially 38-to-1 leverage. So it's a very different animal in the euro in the sense that the volatility is really low. So they give you tons more leverage. Gold is 18-to-1. Bonds are 22-to-1. And natural gas is 3.5-to-1. So you get to these different underlyings, and you'll say things like, "Oh wow, natural gas must be pretty risky." It is. It is. Natural gas, which is only a $22,000 contract, it costs $5,700 to hold that contract overnight, and but it only has less than 4-to-1 leverage, whereas the S&Ps have 13-to-1. So everything, you can determine risk by leverage. You can also determine back of the envelope risk by buying power reduction. If you kind of want to know where your risk is, you always look at your buying power reduction. In this entire industry, just if you want a back of the envelope way of looking at risk, look at your buying power reduction. Whatever the brokerage firm requires you to put up on to make a specific trade, that usually goes out to about 2 standard deviations of risk, and that is a very good measure of how much risk you're taking. So BPR and the leverage behind BPR in the futures world is really a great back of the envelope way of determining what your risk factor is. Okay. Now I'm going to take you on a brief discussion of pairs trading. And the reason I'm going to do this is because very few people talk about pairs. There's always been this world of what we call basis arb. Basis arb is the difference is trading the spread between two different underlyings. Essentially, the spread becomes a product. When I grew up in this business, I was trading the spread between the S&P 100 and the S&P 500 for almost 20 years of my life. I traded that one particular spread, made markets in the S&P 100, and I used the S&P 500 to hedge it. That's what we call pairs trading. At the time, we called it basis arb. When we got into the retail side of the business, we changed the name because basis arb was too complicated, and we made the name pairs trading. Now, with everything being electronic, pairs trading is essentially a great way or an interesting way to trade futures when you feel like there's a divergence in price. And what pairs trading does is it allows you to trade different futures products that are highly correlated against one another to reduce your risk and extend your duration. Again, this is so interesting because it was never explained to us this way when we were on the floor trading. And since we've built, retail technology and we run a think tank right now, and Tastylive creates all this research, what we learned about pairs trading is it's a directional bet. There's no theoretical edge whatsoever, but you make the determination based on price extreme. And when you feel that either a spread has gotten too wide or a spread has gotten too narrow, like, for example, when you feel like gold is too expensive relative to silver, or silver is too expensive relative to gold, or natural gas is too expensive relative to crude oil, or crude oil is too expensive relative to natural gas, or the S&Ps are too expensive relative to NASDAQ, or the NASDAQ is too expensive relative to S&Ps, those are all highly correlated underlyings. And what we do is you make the determination on which way the price is extreme, and then you buy one and sell the other. Because they're so highly correlated, the risk is reduced as opposed to doing one of them on their own, naked either way. The risk is reduced by about 80 to 85%. On the CME website, you can actually see how much the risk is reduced because they post all the intermarket spreads and they show the risk reduction. So each one's a little bit different, but the average is between 80 and 85%. And the other beautiful thing about pairs is because you have offsetting positions and because they're so highly correlated, they extend duration. which makes them fascinating. So pairs trading is a strategy that diversifies the portfolio by taking advantage of, or trying to take advantage of, price extremes in correlated markets. It's important to account for contract size and implied volatility to determine how many to do. So like, for example, I'm going to do 5 2-year notes against one 10-year note. I'm going to do 5 micro Russell contracts against 2 mini NASDAQ contracts, because those are all we call vol adjusted notional. You'll learn that. It's not complicated. We'll show you in a couple seconds. Pairs trades are also referred to as basis arbitrage because you're betting on the spread. You're not betting on either underlying, you're betting on the spread between each underlying. Most retail customers, when they trade futures for any extended period of time, when they want to give themselves time to be right, they trade pairs. So some interesting pairs I'll post on this trade here. So what constitutes a pairs trade? Well, gold versus silver, 1-to-1. Notes versus bonds, 2 notes versus 1 bond. ZN are notes, ZB is bonds. British pound versus euro, 2 British pound contracts to 1 euro contract. These are all kind of standardized, and you can see all the standardized pairs on the CME website if you want to go there. These are taken directly from their website. Russell versus NASDAQ, 5 RTY to 2 NQ, or you can use the micro version of any of these. Corn versus soybeans, 2 corn versus 1 soybeans. Corn is ZC, soybeans is ZS. So again, these are all highly correlated underlyings, and they're vol adjusted notional, so that the amount of capital committed to each side essentially equals each other, adjusted for volatility. So it's essentially a longer duration trade. It's a highly correlated longer duration trade with a reduction of risk kicked into the back end. So why use pairs? Pairs are designed to be delta neutral, and you're betting on the spread. You're using IV to adjust for the notional risk. You can also adjust trade size by buying power reduction if you prefer. So the beautiful thing about futures, unlike listed options and underlying stocks, is that in the futures world, everything's vol adjusted. So if you use buying power, you just use buying power to match up both sides. Pairs trades generally reduce risk by up to 85%, like I just mentioned. Longer short, it's easy. There's no additional requirements that are needed to perform a short sell. You can long or short anything you want. There's no uptick rules or anything like that. There's also no pattern day trading. You don't have to worry about that for minis or micro contracts. And micros have made pairs trading much more accessible to retail investors. So why use pairs trades? Because they're highly correlated. And that gives you a sense of stability. It gives you a sense of comfort knowing that you are long or short, long and short, 2 highly correlated underlyings. Why use pairs trades? Because they reduce the volatility of a naked futures trade, or a static. We call a naked futures trade a static futures trade. Pairs trades reduce the volatility of a static futures trade. How do you manage a pairs trade? So this is the hard part. Since it's a very black and white trade, they are a pure directional bet on a spread or on the basis. So you can either reduce the size. So you've done a bunch of contracts, you can reduce size. That's one way to manage. Or you can manage by P&L. If you're up some money, you take a profit, then you might leave some on, or just take the whole thing off. But you have to manage essentially by P&L. But generally speaking, we do not sell options against pairs because it complicates and kind of mucks up the trade itself. So we either reduce size, or we close out some of we reduce size, or we take some of the position off. We tend not to sell options against the futures trades. And keep in mind that the tick sizes for futures products are not standardized. So just be careful there. It's not like, again, this is what we call nuanced know-how. Just be aware of this little thing called nuanced know-how. When you talk about futures, you can't have a futures discussion without understanding that futures work the same way that stock options work. Futures options work the same way that stock options work, and that futures, the expected moving futures, is virtually the same as the expected move stock. It's all just a derivative of implied volatility. So once you know what implied volatility is, you can tell what the one-day expected move is in futures. So a 19% implied volatility in a future is going to equal an expected move of 1%. So for example, just to give you an example, if the S&Ps, as measured by the VIX, if the S&P volatility is 17%, if the VIX futures are 17%, the VIX is 17%, the expected one-day move in the S&P futures is just a hair under 1%. So knowing the daily, the weekly, and monthly expected move ranges helps you establish reasonable intraday price targets with respect to the options. The easiest way to do this, and again, this is to use a highly correlated ETF, or you can use the futures itself if you want, of course, but you can also use a highly correlated ETF to establish a futures implied volatility, and then you can just take the expected move right from the ETF, or you can take the volatility and then you take the volatility from the ETF and determine the expected move from futures. It's a really cool back of the envelope way to do it. It's also a super simple way for really advanced technology, like they offer at Tastytrade. Really advanced technology like that already does all that work for you, and then it beta weights the futures implied volatility and beta weights it to the SPY. So what you end up with is an expected move on any futures product that is given to you in SPY terms. It's a very slick way of doing it, and it helps to normalize and essentially commoditize all your positions, whether they're futures options, regular options, stocks, whatever it is. Everything gets beta weighted to SPYs off of the various futures ETFs. So how do you determine expected move? Well, there's the same model that we just essentially gave you. So if you wanted to know the math behind this, you can always go look up just go back to this slide, or if you want to see, there's 100 different kinds of models around, but basically they all get to within a basis point or two of the same number. So I'm going to wrap this up with talking about probabilities and understanding why probabilities matter. For futures options, the probability of the underlying closing 1 penny in the money is the per strike delta. So if you're looking at a futures options, I'm just going to give you, I'm going to make up an example of a future. Let's just say I took a future. I don't even know if they have orange juice futures anymore. I'm not even sure if they do. I don't think so. I'm just thinking back in my head to the old days of trading places. And let's say there was a crazy out of the money option. And it was at least close to 2 standard deviations away to the upside. And you looked at it and it had a delta of 5. So XYZ future has a delta of 5. And you looked at that, you said, what are the chances of this option going in the money? So as a buyer of that option, you say, well, it's got a 5 because it has a delta of 5. So it's a 5% chance of going in the money. So if you were buying it, you have a 95% chance of losing and a 5% chance of it being worth 1 penny. If you're selling it, you say I have a 95% chance of success because it's only got a 5% chance of going in the money. That's using the per strike delta to give you a probability or a probabilistic outcome. Expected move, understanding expected move helps you set the strike selection, helps you adjust different levels when you've already made a trade. It also helps you with setting exit targets based on, if you're long something, where you want it to go, if you're short something, where an expectation, like you're not going to, if something has an expected move of $20, you're not going to play for it to move $50. I hope not. And if something has an expected move of $50, you're not going to play for it, to move $100. It's just setting reasonable expectations. It matters for listed options. It matters for futures options. Okay, that is the end of this presentation. We gave you about pretty close to 3 hours of content from the live shows that we did all year as Tastylive on the road, myself, Jermal Chandler, and Pete Mulmat. I think this year we did 8 live shows, 1 in London and 7 in the US. We mixed them up with futures and futures options and also listed options. We were in 8 different cities. This was something that was very important to us. This is the first time we've ever done a digital collectible on a virtual stage and done the show virtually. This is also an introduction to how we are going to, in the future, deliver things to our Tasty Crypto wallet. It's all going to be blockchain based. We are the market leaders in this stuff. Nobody else is even probably within years of where we are in delivering this kind of content. Hope you hold on to this. Hope you watch it as many times to make yourself comfortable with the content. Hope this gives you an idea of what you're going to see when you come out to the live events we are going to do in 2024. I think we're going to do a record number of live events all over the world in 2024. This gives you an idea of what our educational events are like. We have some fun events we do too. This gives you more of the educational side to it. We plan to go, again, a couple of international locations and all over, domestically, all over the US this year. We also hope to be able to deliver you another or maybe even multiple digital copies of what we do with some variations to it and some fun stuff if you all like this format. So enjoy. Let us know what you think. My email is tom@tastylive.com. You can email myself, Jermal, Pete, or support@tastylive.com if you have any questions. And we look forward to seeing you at one of the live events or next time around on the virtual stage. Thank you so much.
So what are you doing here today, Tom?
Huh?
What are you doing? What are we on this big, beautiful stage for?
I came to see Jermal.
This place is cool. What is this?
Can't tell you. We'd have to, kill you.